Hello, I'm Tony Filippone, and we're going to talk about the best investment strategies for retirees who want safety and growth. And before we jump into that, if you want to design a portfolio that's based around your ability to absorb risk as well as your goals and objectives and what you want to accomplish, what we can do is set up a short 15-minute call together, and there's a link below to do that. There's no charge to do that. You can sit for 15 minutes or so, and you can ask your questions and see if it makes sense for us to talk further. Or if you're not ready to do that, we've got a free mini retirement course for you below. There's a video that you can watch. So the link to those are both in the comments below, or in the section below. So just take a look at those and check that out. So you want to know the best way to achieve safety and growth with your investments? Well, this is really kind of a tricky question, right? Because often these two goals are at odds, with each other. For example, the more risk that you're willing to accept, it's generally accepted that you're going to get a higher rate of return for that over the long run. And then, of course, the more safety you want, oftentimes you have to just accept a much slower level of growth to achieve that safety. But there some ways where you can actually, have your cake and eat it too? Well, I think there are. I'm going to share some of these. Actually, I'm going to share with you four powerful strategies on how to invest for both safety and growth. So let's jump right into these and take a look. The first one is investing in dividend-paying stocks. I know that's nothing new, but we want to talk about why is that a safety and growth approach? Why do I feel that way? Well, number one, you get paid a dividend with these dividend-paying stocks. It starts paying you right away, whether the market is up or down. You're getting paid. You're starting to get your principal back in the form of these dividends right away as soon as you buy the stock. Usually every quarter, the stock is paying you, and that's important because a lot of times we might buy a stock with a totally different objective. We buy a stock with the hope that it's going to go up in value tomorrow. But will it? We don't know. We call that speculation. We're speculating, we're guessing, we're hoping that tomorrow it's going to be worth more than it is today. And maybe we have some reasons to believe that that could be true, but we don't know for sure, right? We're just kind of speculating. But with a dividend paying stock, we can be pretty certain that we're going to continue to get that dividend. It's not guaranteed, but most companies who are paying dividends continue to pay dividends and usually increase their dividends over time. And so we're starting to get paid on our investment right out of the gate, which is really nice for the safety feature. Um, Normally, too, bigger, safer companies are the ones that pay these dividends. In fact, if you go out and buy dividend paying stocks, you know a couple of things about the company without even doing any research. What do you know? You know that they're profitable, you know that they're running an efficient company, right? Because if they didn't have excess profits to return to you in the form of a dividend, well, then you wouldn't be buying them, right? So just the nature of this type of an investment leads us into a safer, profitable, established investment. And that's sounds like what we're after with safety and the growth, right? So another thing to consider about dividend paying stocks is we do still need to be cautious, right? We don't want to just go out and buy two or three of the best dividend paying stocks and plunk all of our money into that because it wouldn't be diversified enough, right? So we feel a dividend stock portfolio should be part of a larger strategy where we're going to diversify and maybe buy 30 to 35 of the best dividend paying stocks out there, and then research the market periodically to make sure we stay in the right ones, the ones that are still strong and paying dividends and doing well, right? So diversification is key if we want to keep this in and have it qualify as a safe investment. So dividend paying stocks is number one. What's number two? I would say number two would be something called structured notes. Now, a lot of my clients, when I first meet them, have never even heard of a structured note. Maybe you haven't. But what it really is basically a pre-negotiated bond with a major bank, like a Chase Bank or a BMO Bank, and we pre-negotiate these bonds with a 1 year. The way we do it, there's all different ways to do it, but the way we do it at our firm is we look at buying a 1 year note. So that means we're going to get our principal back at the end of a year, and during that year we're going to get a stated interest rate. So we're going to know what kind of interest we're going to get, and these structured notes pay anywhere from 7 to 16% interest in just 1 year, which is a really nice interest payment. A lot of our clients have averaged 8 to 9% just in their structured note portion of their portfolio. Um, so we like structured notes. What about risk of these? Is there any risk? Of course, it's still an investment. So the way these work is they're tied to an underlying market, like a market, usually several market indexes, like the S&P and the Nasdaq and so forth. So if the underlying markets are down by 30% or more for the year, then you're going to participate in those losses with everyone else. But if those markets are not down by 30% or more, well, then there's no loss. You get 100% of your principal back, and you get the stated interest rate, and you win, right? And you start over and you buy another note next year. So why 30%? Well, that we find 30% to be a nice number because about 94% of the time it's not an issue. It's a non-issue, and it becomes a very safe type of portfolio. Is it perfect? Does it work all the time? No. Here's a way to make it even less risky. What we'll do is we ladder these notes. So that means we'll buy a note that matures 1 year from now in October, 1 year from now in November, 1 year from now in December, maybe 1 year in November. So we'll ladder 4 different notes maturing at 4 different time periods. This way, if one of them does experience some loss, hopefully the other three won't, and again, will be protected. Another reason why these are protected, besides the hedge, is we get the stated interest rate even if there is a loss. So even if the market is down and we participate in a loss, and let's say we had a 30% loss 1 year, well, and we had a 10% interest rate on that note, well, we're hedged the 10, at least we got the 10% interest. So we didn't participate in the whole 30% loss because we got the interest, which buffers that loss on the way down. So structured notes are a great tool, something to look into if you're not familiar with them. Certainly, we help our clients with this type of thing all the time. Now, if you're not sure the best way to utilize these two strategies I've just talked about, or the two even more amazing strategies I'm about to share with you, and you'd want a little more help implementing this stuff, schedule yourself a 15-minute call on my calendar and let's talk about it. There's a link below to go ahead and do that. Or if you want more information, make sure you check out my free mini retirement course video, and there's a link for that below as well. We'd love to see you on the other side of that. So let's talk about the other two safe investment strategies, or strategies designed for safety and growth combined. The next one, the third one that we're going to talk about, is a buffered ETF. If you don't know what an ETF is, you can look that up. It's kind of like, if you remember what mutual funds are, ETFs are very similar. They're just designed a little differently. This particular ETF is designed with a buffer into it. So what's a buffer? It just means, like, for example, if we preset a buffer at 15% on this ETF and the market happens to lose 20, well, what do you lose? You only lose the difference. You only lose the difference between the buffer and what the market actually lost. So in that case, you would lose 5%. Well, 5% loss is a lot better than a 20% loss. And these buffers have these built-in hedges into them. So it again lowers the downside loss on that investment. But for this protection, there's usually a bit of a trade-off, meaning when the market is up, you're also not going to get the entire upside. So you might only capture 75% of the upside of the market, but you've got a 15% buffer against losses on the downside of the market. So a nice way to, if your goal is safety and growth, a buffered ETF might be something you'd like to look at. And again, the way our firm does it is it's more of a part of an overall strategy where we'll actually put multiple buffered ETFs together to kind of round out the highs and lows and give you just the sweet spot, the best place that we can get for you, playing the averages in your favor. So the fourth strategy I want to talk about is a very special type of an annuity called an indexed annuity. Now, these are issued mostly by big, strong, safe insurance companies. Of course, you need to check the ratings of the company to make sure it is big and strong and safe. The ones we use are typically A-rated and above, which makes them very big, very strong, very safe. Now, your growth is typically linked to an index, like let's say the S&P 500. So if the S&P is up, you get all of the gains up to a predetermined cap. So let's say in this case it's an 8% cap. So if the market's up 10%, the S&P is up 10, you're going to get 8. If it's up 12, you're still only going to get 8. But if the S&P loses 10%, you do not participate in any of the losses. So this strategy is the only one I've talked about so far that protects your principal 100% in a down market. So very safe, and yet can be a lucrative strategy for a lot of people. So these are not by any means the only strategies that will help you seek out growth while keeping at least some of your money safe, but they are a few of the best ones that I have found. And they are strategies that I've personally used, and they worked very well for myself and my clients. They work particularly well when used as part of an overall strategy or plan that takes into account both your individual ability to stomach ups and downs of the market, your risk score, and also the goals for your money. What are you trying to accomplish? What you're trying to accomplish is the first thing we need to figure out, and then work backwards to figure out which products make the most sense for you. So if you found these ideas helpful and maybe would like a little more help to implement them, to put them into practice, I help people all over the country do exactly that. So again, why not schedule a short 15-minute phone chat with me, get some of your questions answered, find out if you qualify for a longer strategy session by using my calendar link below. There's no cost, there's nothing to buy at this point. Or if you need more information, please feel free to take advantage of my free mini retirement course video in the link below. And I hope you really found this video to be helpful. And I look forward to talking with you soon. Have a great day.